Good morning, good afternoon, good evening. Welcome to the Geneva Association Risk Conversation webinar on climate risk assessment for the insurance industry. We have particularly a large turn up today for this webinar, with some of you joining as far as Asia and Australia at very late hours. I wanted to thank you all for taking the time to tune in. This webinar is being recorded and will be available together with the presentation after the event. My name is Maryam Golnaraghi. I'm the Director of Climate Change and Emerging Environmental Risk at the Geneva Association. I'm joined here by 4 leading experts from the insurance industry who are also members of the Geneva Association Task Force on Climate Risk Assessment for the Insurance Industry. We have Adamczyk, Vice President of International Regulatory and Government Affairs at Prudential Financial, Martin Bertok, Head of NatCat and Cyber Modeling at Swiss Re, Michel Lacroix, Head of Group Investment Risk and Sustainability at SCOR, and finally, Jörg Treinson, Lead Modeling Expert at Munich Re. Over the last 5 years, actions for transitioning to a resilient low-carbon economy has been gaining momentum in both public and private sector. A pivotal point was the launch of the Financial Stability Board's Task Force on Climate-Related Financial Disclosure, which raised the need for decision-relevant, clear, consistent, and comparable climate risk information, and need for industry-specific methodological approaches and scenarios. Now, doing climate risk assessment and scenario analysis has been gaining momentum among financial and insurance regulatory bodies as well. The insurance industry started early on from very strong foundations in NatCat and a variety of activities that it has been undertaking. Among that has been joining various pilots and experiments that have been actively engaging with regulatory bodies, data providers, consulting firms, and multilateral organizations. While significant lessons have been learned, these pilots and experiments have not yet led to production of what we believe are decision useful and meaningful information from which actions can be taken on. Against this backdrop, in 2020, the Geneva Association stepped up the industry-level collaboration globally by setting up the GA Task Force on Climate Risk Assessment to revisit, innovate, and advance forward-looking methodologies that could produce meaningful and decision-useful climate risk information. This is for life and P&C insurers on both sides of the balance sheet. But also our goal has been to not only help the industry in developing these methodologies, but also to contribute to the international efforts to converge on robust solutions. Now, in the next slide, this GA industry-led task force is comprised of 17 largest life and P&C insurance companies, bringing together a very rich range of expertise from across the balance sheet and all relevant areas with a very active network supporting it. Today, we will discuss key findings of the first report of the GA task force, which is shown in the next slide. Essentially, what this report does, it lays out the foundations for a holistic decision-making framework for climate risk assessment across 4 dimensions: P&C and life, both sides of the balance sheet being liability and investments, considering 2 time horizons, short and long term, and also looking at physical and transition risks. This report lays out the foundation of for the deep technical dive that we will be taking in 2021 to converge on some solutions around this dimension. Now, in this slide, we have summarized 4 key findings of the first report that we will demonstrate during this webinar. We will show why converging on robust decision-useful methodologies is work in progress and requires extensive collaboration. We We'll dig into key considerations for performing holistic risk analysis across the balance sheet, being mindful that the methodology should start with defining decision-relevant questions and objectives before we jump in to develop the tools, not vice versa. And then we finally get into what kind of tools, qualitative and quantitative, may be used for achieving this task. With no further delay, we will now start the presentation. Martin Bertok from Swiss Re, we will talk about the overall framework of the task force and then look into the decision aspects of P&C side, from the liability side of P&C. That will be followed by Ian, who will focus on decision aspects of the liability side of life insurance. And then Michelle bring it together for investment side of both life and non-life, life and P&C. And then finally, Yorkter, we will give an overview of the overall aspects related to tools. And then we will have a panel discussion followed by Q&A with the audience. In the meantime, I just want to remind you, please use the question box to send in your question. I will be monitoring it and making sure that to bring up your questions to the panelists. So Martin, over to you for your segment. Thank you.
Thank you, Maryam. I hope I'm audible well. Firstly, let me thank you for the opportunity, actually, as a person to be part of this Geneva Association task force. It's been a very lively experience. And I think being part of that task force was part of kind of also the results we produced here. That's why I'm starting from that angle. The state of the art in addressing climate change in the industry, in the insurance industry, is clearly in a rapidly evolving process with many kind of initiatives taken globally. Similarly, also that task force started from a very diverse angle in terms of participants, in status of where the companies are in the process of addressing climate change risk in their books on the liability side, on the asset side. Still, this representation, this broad task force also helped to kind of cover all these angles which might matter, which at first sight you might just start with physical risk, realizing, oh no, there's many more aspects. So it was very helpful to have that diverse group. At the same time, as many of you could imagine, having been part of that dialogue probably as well somewhere, diversity here makes it also more tricky to align on topics, to find the right topics, the right language to discuss. And so the work of this task force has clearly not been to just come together and write down in a report a ready-made story with an obvious starting point and an obvious ending. It was rather an elaborate process in kind of going back and forth in discussions where also recommendations and findings emerged while working. And that's in addition to what we just present. I think these findings, recommendations, that's a key asset we could provide here. And one key finding was just that we quickly noted that we have to define the landscape much better, kind of what's the arenas the task force has to look into, what's kind of the individual risk factors or items to discuss, and what's the language to describe that. And that's what I'd like to outline. If we would move to the next slide briefly. We've referred to, it looks like quite a busy format, and you will see that across the report that we use the table format which looks quite involved, but eventually it's quite simplistic. And in these tables, which go always in the same structure through the report, we've outlined 4 key dimensions. Maryam briefly touched upon these key dimensions before. One is physical versus transitional risk. So we boxed it in these 2 angles. We also boxed it then in P&C versus life and health as the other dimension. We only used, and that was an important step, learning step, 2 time horizons. So a business planning short-term time horizon and a longer-term time horizon in these tables, and also differentiate between chronic and acute risk. That's the 4 dimensions we put in these tables. And if we move on to the next slide, without even going into the detail, first slide being the physical risk and the next one showing the transitional risk aspect, you see a structure of what you will recognize that across the report. And I'm not even attempting kind of to lead you into all the text we see on these tables. So that's already a part of that learning, to just create a landscape, a holistic landscape addressing probably not every and each aspect, but most of these aspects which are relevant here for the insurance industry to discuss. Clearly, not all of these boxes we defined here have the same relevance, the same priority. Be it physical risk on property side being a very dominant one versus probably other areas, maybe on the transition risk for liabilities a bit less dominant. That's part of the discussion you will find in the report as well. What kind of has been an additional kind of finding when creating the tables, when creating the narrative around the tables, is that one topic which you'll recognize, and that's when I dive into my slide after. If you just move one slide more and even one more, it's in terms of concluding on P&C, it's what's the questions we need to ask? While kind of creating the landscape is one angle of today and in the future, what does climate change mean? What are the important questions to ask and what's the answers to find before we even kind of think of what's the analytics we need to answer those questions? And our discussions revolved quite a bit around that. If you move on to the next slide, please, giving you a flavor on where on the P&C side, kind of these particular pressing points. When it comes to the P&C side, that item sticking out for, yes, thank you, for P&C risk, it's not the chronic angle, why we discussed it as well, it's the acute physical risk. Probably also the discussion right now is the hottest one. It's not the only discussion to have had, but we clearly learned in our task force there is this natural focus on acute physical risk, but it's not a new risk factor. Clearly going through the companies, all the companies have extreme weather already on their horizon. Today's CAT modeling is a very well developed tool to address that risk, to manage that extreme weather risk, where climate change is a modification to that one. So putting climate change not into kind of like a new risk factor, but for kind of the key risks on the P&C side as a modification of what we have right now, which is quite an important differentiation we found there. Clearly, NatCat models as being a very good starting point for the near term, kind of to find answers for questions in the next business planning horizon, couple next years. Transition risk, when it comes to the P&C side, we discussed as well. Clearly, in terms of dominance, less of a priority, but it's still there. On the liability side, there is litigation risk, but clearly we also discussed it a bit from the opportunity and risk landscape at the same time. So with transition into renewables, for example, these opportunities coming up. One key conclusion we had, particularly on the physical risk side, also reflecting a bit of discussions elsewhere in the industry, it's starting with a simple framing. And I mentioned before already, this boxing is simplifying things, even if the tables look large. A very important conclusion is working with two time horizons only. That we think of a business planning horizon, what's next, what's kind of the decisions we have to take to steer our portfolio, and where CAT models, for example, on the physical risk side might provide very good answers. And then in terms of what's the questions we have to answer for the more strategic dimension, 2030 to 2050, I'm not locking in on an exact figure, but longer term, where the decisions to take today, 2021, are not that obvious. And we also learned that we propose some of these kind of, what's the questions we need to answer for these time horizons, being an important learning before we even dive into analytics. That's giving you the flavor of what you find in the report when it comes to P&C liabilities. And with this, I'd like to hand over to Ian to speak about life and health.
Thanks, Martin, and hello, everyone. I'd like to echo your remarks, Martin, about thanking Maryam and the Geneva Association for the opportunity to work on this task force. It's really been a great learning opportunity and really illustrated the point that Maryam touched on before about collaboration and the benefits of it. If you could turn to the next slide. Similar to the table that Martin touched on for the P&C side, the table we have for the life insurer liabilities provides an overview of the risk landscape split by physical and transition risk and short and long term. On the next slide, we highlight some of the key considerations that are illuminated in the table. And one of the interesting things is that they're generally similar observations for the life side for both the physical and transition risk side. Starting at the top, the effects of climate change are not expected to have a material impact over the short term, given the long-term nature of life liabilities, the ability to manage and limit exposures to areas that are or will be susceptible to some extreme events, and also the time it'll take for transition efforts to impact these coverages. Whether the impacts will reach a statistical level of significance over the long term is a bit more uncertain. It was definitely an area of discussion among the group. And that's really reflecting a number of the factors that need to be considered as we look at these exposures over the long term. Some of them including, what is the extent of action that society takes to transition to a low carbon economy? What is the pace? How successful is it? What are the second order effects that may arise out of climate change that could impact insurance liability protections? And then also, how do we factor in the ability of insurers and the insureds to mitigate any increased exposure to the risks that they may face as a result of climate change? And the interplay of these variables really highlights the challenge of assessing the long-term impact, which we note in the paper is an area that definitely warrants further study. So with that, I'll pass it over to Michelle, who will touch on the investment-related aspects from both the life and P&C perspective.
Thank you, Ian, and I would also like to thank the Geneva Association to have provided me with the opportunity to join this amazing task force working on this so exciting topic. As far as investments are concerned, what I want to say is there is really no difference between P&C and life. It deals with the maturity of your investments, with no consideration for the type of liabilities that you are backing. Moving to the next slide, you will see that finally investors, as the rest of the business of the insurance company, is exposed to both physical and transition risk. We need to have a very clear idea of what we want, what we intend to achieve when performing this risk analysis. Basically, we all know that it goes in opposite direction. If we transition hardly, quickly, then there is big expectation that we will be able to contain global warming, so big transition risk, but moderated physical risk. On the opposite, if it happens that we do not transition fast enough, then transition risk will be limited in the investment portfolio, but it's likely that we will be strongly hit by physical risk. Moving to next slide, we can consider that in terms of investment, we are much more advanced in the transition risk analysis. We have been pushed by regulation and by the development of a lot of methodologies. It's also because it's very close to what we're doing in terms of credit risk analysis. Finally, it's adding a non-financial dimension to credit risk, not more than that, even if it's already tough to deal with it. And it's also shorter term horizon, so it brings us back to the uncertainty when trying to develop a portfolio by 2050, for instance. In terms of physical risk, we need to consider that there are direct investments, physical investments, such as real estate, but we also can be exposed through plant locations of large cap issuers, for instance. So there are a lot of different dimensions that need to be taken into account when dealing with this risk assessment. In terms of mitigation, basically you have two ways to mitigate it. Either you exit or you engage. Of course, it's always a mix of all those strategies to make sure that you deal correctly with these new types of risk that you have to onboard. My conclusion will be very straight to the point. Start with simple ways of trying to assess and practice to be able to better understand the tools, to better understand the methodologies and their limitations, and how you can take the best of it as of now. And I turn it to your turn.
Maybe he's having technical difficulties with his sound. In the interest of time, given that everyone in the task force has worked equally on all the issues, maybe we can use, Martin, would you mind to go over Jörgter's slides and then we will bring Jörgter in the Q&A? Yep, so.
Happy to do so.
Thank you so much.
I pointed already to kind of the first bullet point we mentioned here. Decision relevant is the word sticking out there. But we noted also in the task force, we have to do a better job, and we did also a draft job on that. What's the questions we need to answer? And what's the decision we can take already today? In what direction to move? So not decisions we take in the year 2050, but today. And for that, it needs a holistic picture, which is a big word. We also at the same time said simplistic, but it's holistic, forward-looking. So keeping the level of granularity at the high level, but include the whole landscape. And starting from what do we want to answer rather than what can we do with analytics and then see what's the questions we answer. This is our first key learning, I think the first bullet point here as well. Linking to that, we realized also quite quickly looking through our broad, wide tables in these two time horizons I mentioned before, that for that business planning horizon, probably quantitative analytics, also where CAP models play a role, where investment analytics are well developed, more quantitative approaches might work quite well and also deliver answers to kind of typical questions we might have there. So how much climate change, for example, is already involved in what we see today as a risk landscape, while when it comes to this more strategic horizon where even the questions to answer in terms of insurability, in terms of, let's say, strategically changing a product range you would offer, that there's much more movables around, where at the state of play today, a qualitative assessment will lead to a much more robust perspective on this broad landscape to deal with. And kind of you realize probably from the comments we're making here, it's not that the task force concluded with a complete recipe on step 1, 2, and 3. So there is a second report coming, which addressing particularly the regulatory disclosure perspective of the work. And there's more work to be done. So what's next on our agenda? It's particularly also thinking on what's these decision points we have to address, what's metrics and maybe analytics, which then help to kind of take decisions today. So things which are relevant also for today. Also thinking of scenarios where climate change might often be not the only movable piece. So there is many other factors moving at the same time. What to use in that angle. And in that mix then, once kind of questions and the decisions to take are more clear, also look at the tools which work best. And CAP models which spring to mind for everyone probably might not always be the first answer there. And so quite a bit of learnings out of that diverse task force we had, and we sketched them out nicely in my view, but clearly also learnings which point to next steps to be taken. With this I close.
Yeah.
Maryam, hand back to you.
Thank you so much for that. And I think just in a summary, one of the experiences that we had through hours and hours of deliberations in the task force is the need to get intimately familiar across the balance sheet, across those dimensions that we talked about, you know, looking at physical and transition risk, looking at different time horizons, and really converging on what decisions are we talking about and what are the objectives of the analysis. So with that, I want to go back and maybe take a few minutes to start digging deeper into what you have just presented. Maybe starting back with Martin again, going to the P&C and liability side of this, if you can really give us a little bit more into how do you use the tables that we've produced in the report and bring it down to actually starting that process in the companies. What examples you can give us in terms of how physical and transition risk truly get into defining the decisions? Maybe we start from there.
Yeah, Maryam, I'm happy to give some thoughts around that from a P&C and liability side to frame that again. Thinking of the business planning time horizon, so the next couple years, one one of the key questions out there, we realized also in our discussion, is also how much of climate change is not a new phenomenon, it's going on since decades, is already embedded in the way we do our business. Is it part of our extreme weather risk? And clearly our established NatCat models give us there a head start in this very important arena on the liability side. So understanding that, kind of having a quantitative, factual, data-based approach to deal with extreme weather risk. Still, that question, it's quite open on how much climate change risk is in there. And clearly everyone noted in the last 2-3 years also this question of secondary perils coming up as an important discussion point, where climate change for wildfire, for example, might be more tangible already today, and probably also into the future, than, let's say, climate change and hurricane risk, where for the North Atlantic, there are some rather vague, uncertain projections in the more far field, while today the signal of how much hurricane risk is already influenced by climate change is still not a well-established science, or well, the science is there, but the results are not super encouraging or highly uncertain. So creating quite some uncertainty around that angle, while on the secondary peril side, which is probably less of a capital issue for the industry, for most players at least, that the topic is already much more relevant. So kind of once you dig into the table, you start to realize that maybe some factors have importance which before were a bit neglected, as there's kind of this focus on key perils first. A second item which I think adds there to you find quite a bit of discussion around that, climate change is not the only evolving factor. How to account for that? Thinking of the last 5 decades of insured losses, economic losses, there's been about an order of magnitude of growth. So a factor of 10 from the 1970s to today in terms of insured losses. And clearly that's not all climate change. Climate change is probably a part of it, but it's very well masked. But there's massive other risk factors moving at the same time. Urbanization, urban sprawl in exposed areas, coastal inhabitation growing very rapidly, be it in Southeast Asia, be it in the US, actually globally. So how to deal with these factors already for the risk view of today, to not neglect that and kind of build an average of a long dated past, but really have present risk view, but also portray that in the future. That kind of makes that link to what I mentioned before on more qualitative perspectives for that strategic time horizon, 2030 plus, where just looking at climate change and let's say stress testing a status quo of today for climate change, what's the answers you get? What's the questions you could answer actually with what you would do on that analytics? And we're not able to find these questions. So that's where I also suggest this more reframing to qualitative analysis to also help to define the questions, where there maybe quantitative approaches might come into play, but in that mix of many movable variables, including human adaptation, there's a need to first do some thinking around what's the decisions to take today again, and not the decisions in 2040.
Excellent.
I left on the side the transition risk, if I may quickly point to that.
Please.
On purpose, it's I think the priority when it comes to the P&C side. It's this property physical catastrophe risk, which is dominant for most portfolios. There might, however, be portfolios where transition risk plays a bigger role, particularly on the liability side. Will you see litigation coming up and affecting you if you're on the wrong industry segments with your insurance portfolio? But also the opportunity question. There's renewables coming up. We've also highlighted that angle in the report, but clear priority takes more when it comes to the P&C side of things. On the liability side, the physical climate change risk.
Excellent. Thank you so much. And I think we want to keep that idea of, how do you bring transition, particularly you've focused on risk and opportunities linked to litigation and technology. Now, there is also another element that hopefully we can discuss here, is the interaction of transition and physical risk. But Ian, can you give us a bit of a perspective, maybe with a little bit of more depth in terms of how life insurers are going about it, particularly on the liability side, and what are, by way of collaborations and other means, are really starting to help life insurers to think in more depth about liability side and climate risk?
Yeah, happy to start, and maybe just by providing a few examples of the physical and transition risks on the mortality, morbidity, or life insurance side. We mentioned before that the impacts are expected to be less pronounced on the life side than they are on the P&C side, but they certainly still warrant consideration. And as Martin has mentioned, the decision useful aspect is definitely a key point. And assessing the potential impacts over the long term is an area that we think would warrant greater consideration, given the view that the effects in the short term are unlikely to be as significant, given the mitigation actions and measures that can be taken that we talked about before when we touched on the slide earlier. I think there's a few examples. We touch on these in the report in terms of how climate change could impact these exposures over the long term, and some of them probably seem pretty obvious to the group, including extreme heat, exacerbating cardiovascular, respiratory illnesses, potential impacts to agriculture, and the knock-on effects that could have on diet and nutrition of populations around the world, and then also the potential for spread of disease, as climate changes and mosquitoes perhaps migrate to different regions that maybe they weren't at in the past. I think the challenge that on the life side we face, particularly when we think about these items over the long term, is what is the likelihood of these outcomes, and that will be a factor of a number of things, including the success of transition efforts, the pace and breadth of them, and then also how, as we mentioned before, insurers and insured act and respond to the transition efforts, be that adjusting concentration limits, populations themselves migrating to areas where they're less prone to extreme events or some of the perils that may become more common in light of or as a result of climate change. So definitely part of the area of the challenge, and definitely lends itself to, at this stage, the more of a qualitative approach to exploring the potential different pathways, as Martin mentioned, on the P&C side.
Excellent, thank you so much. Let's jump into the investment side, and I see a number of questions coming up by way of, asking about risk matrix for quantitative analysis on the investment side. Michelle, what has been your experiences on the investment side, and particularly working across company to converge on some of the expertise that can shed light on the investment side?
I think it's really, well, for the time being, and given the maturity in terms of climate risk assessment, it's a combination of quantitative and qualitative analysis. Even a quantitative analysis can bring you to qualitative type of results. I think it's really important. Let me give you an example. We performed several what-if scenarios. I don't want to call them anything else because it's a succession of assumptions on climate modeling and how it translates on macroeconomic variables and so on and so forth. So it's highly hypothetical, but still, it gives you information and you can run your portfolio with this what-if scenario. If you do it on your own, on the asset side and exclusively on the asset side, in most of the cases, the result is, oh, finally, I'm fine with the transition because the loss that are likely to occur on the credit spread are completely and more than offset by what happens on rates. But we are insurance companies. And what you have on rates, if your ALM is perfectly matched, you will have to return it to the liability side. So finally, you are left with only your loss on the credit spread. What I mean is, it really has to be a transversal view of your assessment and not only isolating investments versus the liabilities. The cross cooperation goes beyond these metrics. We have learned a lot from our P&C colleagues on the physical risk, what it means, how it can develop, and what types of assets may be most exposed. What does it mean really, physical risk? It's something that we are absolutely not used to tackling on the investment side. On the opposite, on transition risk, we are helping our P&C colleagues on their assessment of transition, because we are much more used to than them to metrics, ESG types of rating. What does it mean? How we can use it? So it really has to be a transversal view on how to assess climate risk, and not liabilities working on their side, whereas assets are still doing their hamster in the wall on their side.
Excellent. Thank you so much. I'm going to bring in some of the questions that I'm seeing from the audience, and I see a whole range of questions around what about, what about how do you really go about and identify the climate signal versus exposures and vulnerabilities? How do you really focus the research? This is one set of questions. And then the second set of questions is, how do you consider various type of adaptation and mitigation measures that needs to take place by various stakeholders, being people, businesses, and governments, to really start mitigating some of that risk, as well as decisions that a company needs to make. So maybe I want to go back and put this into the context of, so what? We are doing these climate risk analytics. So what? At the end of that, we need to make decisions. So if you can comment around where do you see the analytics that we've started to think about how to go about it will have impact on a company's decisions, and how does it consider decisions that needs to be taken by people, businesses, and governments in terms of mitigation and adaptation? How do these things come together? Who wants to go at it first?
Hey, Maryam, it's Ian. I'm happy to take a first set of response. So I think it's a great question, and I think particularly the second part around the consideration of the different challenges and uncertainties is certainly something we wrestled with in the task force, and we touched on in the report. And I think a way we thought of that was that helps reinforce the need for setting out early what are the objectives that the assessment is looking to accomplish, and then from there using that to inform the tools that the insurer employs, and also the idea of utilizing qualitative approaches, knowing that they'll offer flexibility to more easily explore those different pathways, particularly around something like transition risk, where there's a number of different paths that could be pursued on the policy, technology, and legal front that will all have a material effect on how the insurer responds, and as well as the insured. So I think that's a key. It's certainly something that, even though those decisions aren't clear now, warrant consideration, and we as an industry needed to be thinking about it and moving. I think it also highlights the value of collaborating to share best practices and understand what different insurers are doing to inform how we as a group move forward. But definitely comes back to the idea of recognizing the uncertainty is there, not letting that inhibit action or progress, but really using it to inform and narrow the focus of what we're pursuing, and then also being clear in terms of how the results should be interpreted, recognizing and accounting for that uncertainty when it's being assessed.
Excellent. Thanks so much, Ian. Any other comments from your side, Michelle, maybe around?
Maybe I can add something, because I really do believe that the Net Zero Asset Owner Alliance has been instrumental in the way we consider how we can tackle climate risk. For a long time, it has been, when assessing the risk in the portfolio, the idea was to say, there is a risk, we exit. We now consider that the only way to really protect not only the portfolios, but the economies and the communities is to have impact on the real economy. And for this, it can only be a combination of portfolio decarbonation and engagement. Corporate dialogue is key in making the transition. Again, it's not only a question of protecting only our portfolio. Everybody knows how to do it. You exit carbon intensive sectors and you invest in other type of sectors, and the decarbonation is done, and potentially your portfolio is aligned with the Paris Agreement. It's not enough. Our mission, our role is really to support the transition of the entire economy and think about it. It's the combination of these two tools, decarbonation plus corporate engagement.
Excellent. Thank you so much. Martin, I want to jump into a question that has come from the audience around NatCat models. I mean, you covered that in the beginning. The question is, given that NatCat models are a key tool for physical risk in the industry, how do you believe, or do we believe, and we did have quite a lot of discussion about this, in terms of applicability of NatCat models when we start moving forward and we start thinking, longer term of business and into strategic time horizons, where can you sort of sum up how they can be best utilized, and where are the gaps and what needs to happen beyond that in terms of development of tools that could help us create decision useful information?
Let's try. It's a multi-dimensional question you ask, Maryam, a good one. As CAT modeling itself, I think, is a very tempting kind of method we have there, which I think everyone's focused, quickly turning to CAT modeling. And clearly it can answer some questions, but what we also learned in that discussion, I think for that strategic time horizon beyond 2030, there's severe limitations of just thinking physical risk CAT models. As I started before, and maybe also reflecting a question you asked before, attribution science, for example. What is climate change as a driver versus other drivers? I mentioned urbanization, changes to the economy, migration, global migration happening, political unrest. There's many other variables which might be as impactful at some point in time as climate change. To give this gradual progression of climate change just goes on, there might be some very fast other changes we have to observe as well. That's tempting, and I'd repeat probably my comment that for this business planning horizon, a few years down the road, this might be a very good answer, kind of very helpful tool to get quantification. Also in a stress test mode, or kind of the stress testing has to be done very carefully, as the variables are not moving that quickly when it comes to climate in the next few couple of years. And even there, you need to include other things like urbanization, which goes probably at this point in time at a much faster pace in terms of evolving the risk landscape. So CAT modeling is tempting, but in many instances, probably not the answers to getting back to a word Ian was using a couple of times already. It's the objectives. What's the objectives, the questions we want to answer? It's probably about insurability, about viability of our business model in the context of assets, transition risk, adaptation. The CAT models at best are a small step, and probably not the starting point where you need to kind of define the objectives around the CAT model output. So I think to carefully use more into the future, while today clearly it's the backbone on how this industry already deals very well with extreme weather risks. So also not devaluing it. Short term, very strong. For longer term perspectives, probably not the only answer.
Excellent. Thank you.
May I add something, Maryam? I'm finally on the line.
Hello, welcome. Of course, go ahead. Great to have you.
No, I just wanted to say about by stressing the CAT models for 2050, you are only changing the hazard, and what we are interested in is in the risk, and in the risk to that particular entity, insurance entity. And just by changing the hazard does not do anything for all the other components that Martin mentioned that have influence on that entity's risk.
Excellent. Thank you so much. Questions are piling up, so I want to try to catch as many questions from the audience as possible. One question, and please give it a quick feedback. It's about, on the asset management side, we are not getting company-specific information, whereas on the liability side, insurers work with companies, and there is great amount of information about the company. Is there any way that this information can be combined for climate risk assessment for insurers from both sides of the balance sheet? And if so, how is that being achieved? Michelle, do you want to tackle that one? Because I think you've worked a lot working across the balance sheet and getting working with the liability side.
Yeah, I think The main issue that we face is that, as you say, we have different types of information, but also we have different ways of assessing the information that we get. Underwriters have direct communication with their clients, which is not the case on the investment side, and there is the risk that their own assessments, by discussing directly with their either client or seeding company, is not fully aligned with what we get on the asset side. We deal with a tremendous amount of issuers, and for this, we are not able to assess by our own each and any climate exposure of those issuers. So we strongly rely on data providers. We know the limitation. I'm not going to open the debate on the accuracy of information, lack of information, blah, blah, blah. We have what we have, but we absolutely need to make sure that the way we consider it on the asset side is strongly consistent with the information that liability side gets from its business.
Excellent. Thank you so much. I want to come back to a very important question that, in fact, I see several times in different from a different lens, but pointing to the same thing, that from a regulatory perspective, regulators are now asking companies to quantitatively incorporate climate risk assessment in various aspects of business, including premium calculations, underwriting, investments. Yet what we say here is this is work in progress. Are we ready to meaningfully incorporate quantitatively climate risk assessment into all aspects of business? And I would love to hear from all of you, from life side, P&C side of liability, and then investment side. So Martin, do you want to start on that one?
Yeah, at the danger of repeating myself, thinking when it comes to a short-term time horizon, let's say business planning perspective, next couple of years, I think the industry is reasonably doing that already. I mentioned the point that there is maybe a risk that we underestimate what's happening on what we would call secondary peril front, where there's a more rapid signal coming in, be it from climate change, be it from urbanization, than what we would see on the key moving perils like US hurricane, Japanese typhoon, or Australian typhoon risk. So there is a risk that we underestimate that slightly, but I think that the industry has these learning cycles out of you get claims and you learn and you advance your underwriting in that context. There, I think that's an industry piece which has been working since probably a century or even more, kind of to successfully address change, which probably is not always attributed to exactly where it's coming from. So it's this mix of urbanization, portfolio, climate you get, but successfully there. When you go beyond that time horizon, this gets again a bit more tricky. That's getting back to the objectives questions. What's the objectives I'd like to achieve with a quantification in let's say a time horizon of 2050? What's the decision I would drive? And clearly that objective or the question I would ask would quite influence on the way I would set up that analytics there, mindful of the many factors I would need to consider, where just using a CAP model and stressing it for some climate variable which will be present in 2050 will deliver a figure. And just recently there have been a few of these figures out in the industry. Maybe some of them have noted there was an analytics for the North Atlantic hurricane risk coming to conclusion that in 2050 it's about 25% higher than today, all else equal. But now so what? That's kind of what's the question we can answer now with this information, where at first sight you'd say, well, if this is all, then maybe we can deal very well with it. But everyone knows there's a lot of other movable pieces, there's regional differences. So it's again getting the objectives, the questions right first, particularly for these longer time horizons, before diving into quantification at all.
We deliberated a lot about the various risks that are linked to transitioning, and how do they come in terms of design and interpretation of the results. Maybe we can focus for the next couple of minutes, because then we have to wrap up, around transition risk, and how did that come up into the deliberations, particularly when we look at some of the existing experiments that precisely try to do that, try to come up with a more of a hardwired single scenario analysis of 2030 to 2050. How does transition risk considerations come into that interpretation? Maybe Ian, Michelle, you can take on, and Martin and Jörg can wrap up on this one.
Sure, happy to start, Maryam. So it was certainly a key point, and I think it dovetails into the question you just raised around the approaches and some of the pilots that are out there. It was a key factor that pointed back to the value of a qualitative approach, and as Martin was mentioning at the end of his remarks around what is the objective, and using those as guides to really inform the value of the exercise, the direction of the exercise, and then also whether or not it makes sense to be reporting it, because I think the key area was how decision useful is the information, how is it being interpreted in light of all the uncertainties, particularly on the transition front, which is a key challenge. And I think it's that how that information is going to be used needs to be a key point of consideration as the efforts go forward, particularly on the regulatory side, in terms of any pressure to publicly disclose information, knowing that there is a lot of uncertainty, and whatever the outcome is, it could be off depending on, again, what is the pace of the transition efforts, how successful is society, what sort of technological advancements are they that help us move to a low carbon economy.
Excellent, thank you. Just a couple of more comments, maybe keep it to 30 seconds because we want to wrap up and sort of discuss where do we go from here.
Yeah, maybe I could add that still this work of quantification on transition risk is valuable. We do not put a lot of value on the magnitude of the results, but the result is so powerful to raise awareness internally and to try and find solutions. As long as you don't have a figure that shows that there is obviously a risk, it's very hard to have people start to move on. Thanks to the quantification, again, I'm not saying it's huge, it's not material, but thanks to the quantification, you raise the point, what can I do? Can we move from exclusion to best-in-class strategies? Is there a way to select some companies that are better positioned to avoid the transition risk while still operating on those energy sectors, and so on and so forth? So there is a great value in the quantification exercise, but not on the output and the magnitude of the results.
Excellent, thank you so much. Any last comments before we go into closing on this point? Okay, so bottom line is this initiative got underway to bring the industry together at a whole new level to really start thinking about how to do this, how to start thinking about this. And I think our report, our first report, provides the very early foundations of how, as a company, you need to work across the balance sheet to bring this together instead of just jumping into a quantitative exercise without knowing, the decision objective of it and why was it designed in the first place. So we hope that this very first report lays out the foundations of it. As we have, as I shared with you in the beginning, this is work in progress. It's going to require extensive collaboration, not only within the company, but also across the industry, across lines of business of the industry, but also with various other stakeholders, being regulators, data providers, the scientific community. What essentially we have summarized, if you can show the next slide, please. What we have summarized is that we need to take a holistic view of the balance sheet without intending to go complex necessarily, but to really get a good sense and intimate feel about how climate risk on physical transition impacts the balance sheet across the different time horizons with a focus on life and non-life. So the idea is to focus on decisions and what the objectives are first, and then go about and figure out what tools we need to use to solve the problem. And obviously, you know, as far as tools are concerned, what we've heard is we still have a long way to develop all the tools to come up with a comprehensive toolbox that would allow the industry and other stakeholders to really do this right. And in this journey that we have, we hope to tackle that. So with that summary, I want to go back to the panelists and ask you, just as your 1 minute wrapping, where do you feel you know, the key priorities sit, and what do you hope to see in the future of the work of the task force? First, maybe we start with Martin.
Thanks, Maryam. Probably repeating what you said as well. In the industry, we have a few great assets on how to deal with extreme weather risk. When it comes to the climate change discussion, there's, however, much more uncertainty on how to deal with it and what's the questions to ask, the objectives. So for me, it's a hope that the industry now soon makes some steps on these objectives in defining the questions, be it in insurability, be it in reserve setting, be it in risk management, the questions to answer before engaging in analytics, and then take some shallow, simple steps to dive more into this analytics to answer these questions and come to grips with the objectives. And I think we built a good first step here, but work to be done in that
Excellent.
direction.
Thank you so much. Ian, over to you. Any comments from your side?
Yep. Yeah, thanks, Maryam. I think a key is that education, communication, collaboration across the industry will continue to be key. We touched on this a little bit before and experienced it firsthand through the work of the task force. And I think another important item to note is that it'll be equally important for that collaboration to extend between the industry and the regulatory community, as well as other stakeholder groups that are active and engaged in this space.
Excellent. Thank you. Michelle?
Well, I agree. We absolutely need to collaborate, but we also need to take into account the data challenge. We will never be able to push the envelope if we cannot rely on data. So transparency is key, and we need to make all the efforts to get the information, the right information, and to work on methodologies to all align on the same methodology. Otherwise, it will still be everybody working on its side and no possibility of comparable information that can be useful when steering a portfolio.
Thank you so much for that. Jukter, are you there still?
I am there.
Okay,
I am here.
closing remarks.
Yeah, it's really nice to be able to give a closing remarks to a panel discussion I've not been part of. At least I get the closing remarks.
We had technical difficulties, unfortunately, so go for it.
Yeah, so no, I think what we don't have all the answers, we don't even have all the questions to ask, like Martin said. So we need to work on that. That's what we will start on for the rest of this year, or starting next month, to work on that. And then once we have all the questions made down, we can start working on the tools necessary to answer those questions. That's more or less it.
Excellent. Thank you so much. And that essentially is what the task force is going to do as the next step. We will be publishing a report on our assessment of regulatory exercises, together with a meeting with regulators to share our perspectives and learn better about regulatory objectives, so we can work collectively to converge on methodologies that reaches us to those points. And as next steps, we will be coming up with a very in-depth sort of matrix of decisions that life and P&C insurers need to ask themselves on both sides of the balance sheet. We will look at risk matrix, and subsequently we will delve into scenarios that make sense for the insurance industry, and then look at what tools are needed and what are the gaps with the toolbox that we need to develop. With that, I wrap up our webinar for today. Stay tuned for more information from the task force. And again, I want to thank you all for taking the time to join us in this webinar, and I hope you find it very productive. And thank you very much for the panelists to take the time to join us today. Have a wonderful day and stay safe.